Hi, my friends. So I just got off the phone with Don Graves from the Heckham Advisory Group, the Housing Wealth Institute. He's also with the American College as well, and he has written a new book as of March about housing wealth, i.e., reverse mortgages. And Ed Slott, of all people, wrote the foreword. In fact, I think Don is doing some kind of presentation to a bunch of Ed's advisors, however that works. So it's interesting. Don's a good guy. I like him a lot. He said he's talked to thousands of people on his 20 plus years experience in the reverse mortgage realm. And he's landed or closed like 3,000 reverse mortgages. So I think he's closed less than 20% of the people he's talked to. Why I like that is because it shows that a reverse mortgage is not for everybody. It's not. In fact, it's for, I don't want to say few and far between, but let's say 20%, 15 to 20% of the population probably would fit for the reverse mortgage. And those 15 to 20% of the population aren't using a reverse mortgage to get the proceeds to put into a variable annuity. That's not what, bug just flew by. That's not what we're trying to accomplish here. So I want to share with you a couple of things actually, because along these lines, my man Alberto had sent me, he just got a flyer in the mail for reverse mortgages. And I'm going to share you some of the pros and cons on this flyer. I thought it was kind of interesting. And we'll talk about some of the negative aspects of reverse mortgage because I don't want to come across like reverse mortgage is for everybody. Look, it's completely on you. What I do say is if you're struggling financially and you got a bunch of equity in your home, why would you not at least consider it? I don't get it. I would say, why would you not consider it for anybody right out the gate? I don't understand why that would not be the case. Sequence of return risks, that's out there. That doesn't go away. There's lots of stuff that you got to contend with when it comes to retirement, and not using all the tools in the tool shed. That just doesn't make sense to me. Again, that doesn't mean you do it. It just means look into it. And so let's talk about it. So let me minimize myself here. There we go. All right. So I want to start with hold on, just this guy right here. All right. So this is what he, actually, let me see if I can't make that bigger. Yeah, right here. Sweet. All right. So, sweet. There we go. So good news for your retirement was a flyer that Alberto got in the mail. We have some great news. This year, the FHA increased the home equity conversion mortgage cap to $726,000. In the past, the amount was only $679. This means more of your home's value could be leveraged to pay off your mortgage and access tax-free cash. Access more equity in 2019. Even if you were not qualified previously or already benefit from a reverse mortgage loan, such updates could help you take advantage of more of your home's value by accepting more cash each month through a new loan or refi. You may be qualified to receive this loan if your home value exceeds the old limit. You want to refinance your current loan to gain more cash. You are previously disqualified due to past lending limits. Ready to start your retirement call AAG. So remember AAG, that was, I think that's Henry Winkler and Fred Thompson. PS, they always do this PS because people read the PS as they have studies on this. Due to recent home value appreciation, you may have a lot more equity than you realize. That's another great reason to call us to see this valuable financial tool is right for you. Here's the important disclosures. So let's go over important disclosures. See if I can't cancel out this guy here. Yeah, important disclosures. So we're going to read this. All right, let's see here. So important information. Like all mortgage loan proceeds, the proceeds from a reverse mortgage are paid tax-free. These materials you're getting are not from HUD or FHA and were not approved by HUD or government agency. AAG works with other lenders and financial institutions. To process your request for a mortgage, they may forward your contact information to such lenders for your consideration of mortgage programs that they offer. I don't know if that means they're just a broker. I think that's probably the case here. They're just brokering it, but I don't know. All right, so a reverse mortgage increases the principal mortgage loan amount and decreases home equity. It is a negative amortization loan. Now, I want to be clear on this because my man Alberto got, I don't want to say hung up. That's not the right word. He got, this concerns him. Let's just put it that way. So a negative amortization loan, well, let's just go into it. So I want to show you what a negative amortization loan is. So we're going to read it from his Investopedia because there is something you need to know about negative amortization loans. Negative amortization loans is an increase in the principal balance of the loan caused by failures to make payments that cover the interest due. The remaining amount of the interest owed is added to the loan's principal. For example, if the periodic interest payment on a loan is $500 and a $400 payment is allowed contractually, $100 is added to the loan's principal, and that $100 will also get interest on that as well. Does that make sense? Now, there's something that's going to be important here when you hear how these negative amortization loans work, because initially, oh, screw that, but hang tight. Negative amortization loans are a feature of some types of mortgages. Adjustable rate mortgages that incorporate negative amortization are typically known as payment option ARMs. These mortgages give borrowers options that include paying all the principal and interest, paying only the interest, or paying only some of the interest. So again, you're accumulating interest, you're not paying it, it is going to the principal amount. I hope that makes sense. So you get a $100,000 loan, 5% interest. You have $5,000 of interest you got to pay that year. If you only pay $4,000 interest, that means the extra $1,000 interest is added to that $100,000 which you have. So now your principal amount is $101,000. So if we take our trusty calculator, we say $101,000 at 5%, because you still got that 5% interest, times 0.05. Now our interest is $5,050. Last year was $5,000, now it's $5,050 because of negative amortization. You're not paying the interest back, and the interest is being added to the principal and adding to the interest itself. It's reverse compounding, without question. Graduated payment mortgages also incorporate negative amortization. Graduated payment mortgage are fixed rate mortgage that start with a payment level that fails to cover the full interest portion of the loan. You got to be careful in these things, without question, without question. But what else has negative amortization loans? Let's take a look, because the first thing that jumped out at me on these negative amortization was the old-fashioned student loans. Student loans are negative amortization. And we already talked about negative amortization loans happen on a loan that's small, when the payments are smaller than the interest cost. So let's go down to the loan balance on a student loan. With some loans, you can pay less than the fully amortization payment. The main reason to pay less is, not surprisingly, because it's easier on your cash flow to pay less. When you pay less than the interest charges in a given month, there's unpaid interest for that month, and as a result, your lender adds that unpaid amount to your balance. Let's see. Do they talk about student loans here? It is student loans, exactly what this is. I know they got that on here. Sometimes you simply don't have the funds available to make significant payments. For instance, during periods of unemployment, or a balloon payment to pay off the debt too. During periods of unemployment, you might not be able to pay your student loans. With federal loans, it may be possible to apply for deferment, which allows you to stop making payments temporarily. However, interest still applies to the loan balance, and you'll be responsible for the interest unless you have subsidized loans. And you'll often have the option to pay the interest while skipping the larger payment if you want to avoid negative amortization. So student loans are a perfect example of a negative amortization. You're borrowing, again, $100,000. Every year is compounding a little bit of interest. You're not paying the interest. That interest is going back to the principal. And that's exactly what happens with these reverse mortgages, the same thing. So let's go back here to see that. So these are negative amortization loans. If you don't pay the interest will add to your principal, and the interest will also draw interest. The exact opposite of a compounding interest. It's just compounding for the bank against you. I'm not sure that's the worst thing that ever happened, but anyway, you got to be wary of it. Reverse mortgage loan terms include occupying the home as your primary residence, maintaining the home, paying property taxes, and homeowners insurance. Pretty simple to me. Although these costs may be substantial, AAG does not establish an escrow account for these payments. However, a set-aside account can be set up for taxes and insurance, and in some cases may be required. Not all interest on a reverse mortgage is tax deductible, and to the extent that it is, such deduction is not available until the loan is partially or fully repaid. AAG charges an origination fee, mortgage insurance premium, which is required by HUD. That's that 2% initially on the front end, and a 0.5% every year. Closing costs and servicing fees rolled into the balance of the loan. AAG charges interest on the balance, which grows over time. The interest grows over time. It's not paying the interest, it's a negative amortization. When the last borrower or eligible non-borrowing spouse dies, sells the home, permanently moves out, or fails to comply with the loan terms, the loan becomes due and payable, and the property may become subject to foreclosure. So remember, when the last borrower or eligible non-borrowing spouse dies. So if my wife and I take it and I die and she is still eligible as a non-borrowing spouse to keep the house, when she dies, the loan becomes due without question. So someone's going to have to pay it off either by selling the house and giving the bank the proceeds of the sale, or coming up with the cash to pay off the loan. It's literally no different than a first mortgage. That's what this whole thing is just odd to me. I get the negative amortization thing. I mean, but you would know that going into the reverse mortgage. I would think you would know that if you're not paying anything, the interest builds interest on itself. That just seems inherent to me, but maybe not to everybody. I don't know. The whole thing about the loan coming due when the last occupant dies, I don't get that. I mean, inherently. I mean, if you had a first mortgage or a home equity line of credit and the person died, the mortgage would come due first too. They have this called a deed of trust, which means the bank has first priority over you. They have to get paid to release the lien, so that way the kid can come in there and sell the house and pocket the proceeds, or the kid can move into the house and pay off the bank. It's fine. But the bank's not under no obligation on the first mortgage or reverse mortgage to maintain the loan. They say, you got to pay us off. If you don't pay us off, we're going to foreclose. The kid says, I want to assume the terms of the loan. The bank's not under any obligation to take that. I mean, the kid might have horrible credit. Doesn't matter. The bank says, you got to pay me. And you pay me, and you can keep the house. You don't pay me, you're going to have to sell the house and pay me the proceeds. If you don't do either, we're going to foreclose. It's just odd to me that so many people get caught up in this. It's just strange, because that's no different than the first mortgage. All right. When this happens, i.e. When basically it could be subject to foreclosure, some or all of the equity in the property no longer belongs to the borrower, who may need to sell the home or otherwise repay the loan balance. That's just the way it works. I don't find that shocking in the least. So let's go to right here, understanding. This is understanding the mortgage documents, and this is through Freddie Mac, and completing the mortgage documents required for a home purchase. Again, a first mortgage, or it could be a second mortgage, doesn't matter. I just want to show you something. Mortgage deed of trust. The mortgage or deed of trust is a legal document in which the borrower transfers the title to a third party, the trustee, to hold as security for the lender. When the loan is paid in full, the trustee transfers the title back to the borrower. Since the lender is providing you with money to purchase the house, they will use the house as security to ensure repayment of the loan. By signing the deed of trust, or the mortgage, you are giving the lender the right to take back the property should you fail to repay your loans as agreed. If the borrower defaults on the loan, the property can be sold to pay off the mortgage debt. It also states you must keep the house in good repair and maintain insurance on the property. And you got to pay property taxes too. I mean, they might escrow it, but if there's no escrow, because you don't need to do escrow every single mortgage you take. So anyway, that's the pros. Let's see, what was this right here? Oh, right here. So here's what happens. You don't pay property tax. All right. So here's property tax. So we've established negative amortization. It's not just reverse mortgages that do that. Student loans do negative amortizations. A lot of balloon payments are frankly negative amortizations. Never been a fan of balloon payments. I'm not a fan of student loans. I'm just not. But people use them all the time. And rightly or wrongly, they do. Doesn't mean you should, but just means, should you look into it? Sure. Why not? I'm not a fan of balloon payments, but people do them all the time. Rightly or wrongly, they do. But should you look into it? Sure. Should you do it? That's completely up to you. So we talk about negative amortization. We talk about deeds of trust on first or reverse mortgages. It doesn't matter. We talk about they have a right for you to require maintaining the property, whatever that means, i.e. if the HOA that you're in puts a lien on the property, you're in a world of hurt. Can't do that. You got to maintain insurance. You got to pay your bills on time, i.e. the mortgage, you got to pay it on time. At least with a reverse mortgage, there is no mortgage payment. But here's the property tax. If you fail to pay your property tax, you could lose your home to a tax sale or foreclosure. If you fall behind in making the property tax payments for your home, you might end up losing the property. It's literally that simple. The taxing authority could sell your home to satisfy the debt. It might do this through a foreclosure process. The taxing authority might sell the tax lien that it holds, and the purchaser might be able to foreclose. The sheriff's going to come, essentially, what's going to happen. So in other cases, a loan servicer might advance funds to pay the delinquent tax and then bill you for them. If you don't reverse the servicer, it could foreclose. I mean, there's just so many. The taxing authority may foreclose. Let's see if I saw the thing on on the sheriff coming to your house. Anyway, but what happens is the sheriff comes in. They say, you didn't pay your property taxes. You got to pay them. If not, we're going to put you out. And that's what happens. So there you go. So that has nothing to do with reverse mortgage. Negative amortizations do have to do with reverse mortgage. First loans are not negative amortization unless there's a balloon payment of some sort. But generally, first mortgages are not being negatively amortized because you're paying more in interest than, or you're paying your full interest. It's not being added to the principal. You got to maintain your home on a first mortgage. Got to maintain your home on a reverse mortgage. Got to pay the property tax. Got to pay homeowners insurance. You don't actually have to pay homeowners insurance if you own your home outright. You don't have to. You're just taking the risk. A reverse mortgage or a first mortgage won't let you do that, though. So it was pretty interesting. It's good to talk to Don. It's good. He's going to send me his book, so I'm looking forward to reading those for sure. So anyway, pros and cons of reverse mortgage. All right, we'll see you next time.